Hey guys, and welcome back to my channel. On today's video, I'm going to explain the difference between mutual funds, index funds, and ETFs. I'm going to list off some pros and cons of each and discuss which one you should look at using for your investing strategy. I hope you enjoy this video. Let's get into it. What is a mutual fund? A mutual fund is an investing method that utilizes the power of pooled funds from multiple investors in order to purchase the underlying assets such as stocks, bonds, or real estate. A mutual fund is run by professional fund managers, and they structure the portfolio's assets in a way that they believe will outperform the market's return. Mutual funds provide individual investors with the opportunity to proportionally invest in a professionally managed fund. Your proportional investment in the fund depends on the relative amount of money that you have invested into the mutual fund. Fund managers use the pooled investments from the investors in order to purchase the underlying assets. It is their hope that these underlying assets will increase in value. If this is the case, then the investors will share proportionally in the increased performance of the fund. Mutual funds usually let their investors know what their goal is and by how much they want to outperform the market's returns for that financial year. This target that the fund managers set is then the benchmark that their performance is measured against for the financial year. Because a mutual fund is designed to try and outperform the market, these professional fund managers will actively manage your money in order to try and get that result. This means they will be buying and selling underlying assets as they see fit in order to try and achieve a market-beating performance. Because of the active management of your funds, you are then charged a management fee for this service. This fee is charged whether they do or do not outperform the market. So how does a mutual fund work? A mutual fund uses investors' money to invest in the underlying asset classes that it chooses. Bear in mind, they can choose to invest in multiple asset classes. The mutual fund's goal is to try and make more money by investing these funds wisely. They can make money through dividend payments received from stocks or interest repayments from bonds. This money then gets paid out to investors proportionally as a distribution. Another way they can make money is through the capital gains from selling an underlying asset. The fund would then pass on these gains to their investors. A mutual fund's price is measured by the NAV, or the net asset value. This is calculated by dividing the total value of all the assets by the number of outstanding shares in the fund. This net asset value is only calculated once per day after the close of market. Mutual funds are therefore not very liquid, and you're not able to sell or buy these on a stock exchange. Most mutual funds will distribute their money across multiple different assets. This is in order to increase the level of diversification and therefore to lower their risk to market exposure. Mutual funds offer up a nice level of diversification at a fraction of the cost to you if you were to own those companies individually. As mentioned previously, there are quite a few fees involved with mutual funds, and these can include the following: administration fees, management fees, and performance fees. These fees can actually eat away at your investment and sometimes even lead the managed funds to underperform the market returns. Mutual funds generally have quite a large minimum investment amount. Often cases it's about $5,000 to set up a mutual fund. This actually puts mutual funds out of the reach of most investors. Fortunately, there is actually an alternative option here in Australia, and that's called Spaceship Voyager. Here they provide two mutual fund options, which are completely fee-free up to the first $5,000. If you are interested in investing with Spaceship Voyager, then check out my link in the description below to get started with a free $5 investment put into your account. What are the pros and cons of investing with a mutual fund? Some pros include diversification. It removes you from the equation. Some cons involved are high fees, high barrier of entry into mutual funds, some tax implications. If you guys are enjoying this video so far or getting some kind of value out of it, please drop a like or comment down below, subscribe to the channel and turn on the notification bell. What is an index fund? An index is just a way to track the performance of a group of assets in a standardized way. An index fund is a type of mutual fund that is designed to track the performance of an underlying index. It doesn't actually require a professional fund manager to manage these funds. Because of this, index funds are considered a passive form of investing. Another benefit of this is that because there's no professional fund manager, the fees are significantly lower when you invest in an index fund. So how do index funds actually work? The portfolio of the index fund is designed to mimic the construction of the underlying index. The idea behind this is relatively simple. If it mimics the structure of the index, it should therefore also mimic the index's performance. An index fund that tracks the performance of the S&P 500 will be spread out over the 500 companies within that index. It also lowers the risk of human error. This is because you don't have a fund manager actively trying to pick individual companies or pick the right time in the market to maximize the gains available. These fund managers are not only trying to beat the market, but they also have to beat the market plus whatever fees they're charging. So they're under a lot of pressure to try and outperform the market significantly. And this can often lead to them making some poor investing decisions. The value of an index fund is calculated the same way as a mutual fund. Index funds are also similar to mutual funds in that they often require a significant minimum investment as well. Often around about $5,000 is the minimum investment you need. So what are some pros and cons of index funds? Index funds have really low fees and therefore set you up pretty well for a long-term investing plan. Diversification is another pro. They're a passive investment strategy. Therefore you can just set up an automatic payment to your investment account and it will continually invest in the index. Some cons with investing in index funds include no potential for extremely high returns. We've all seen how much Tesla has increased over the year, and investing in an index fund means you're not going to get 600 or 700% returns in a year. There's a lack of flexibility if you only invest through index funds. You don't get to choose individual companies if you want to, and if there are certain companies in there that you actually don't like, you don't have a say in not being able to invest in them. And they can have a high barrier to entry, requiring significant funds in order to get started with your initial investment. What is an ETF? An ETF is an exchange-traded fund. This is a basket of securities that trade on an exchange just like a stock does. An ETF often tracks an underlying set of assets through an index. This index can be made up of any type of financial security, such as stocks, bonds, or commodities. An ETF is extremely similar to an index fund, but with some small yet significant differences. An ETF is traded like a stock, so its value is updated extremely frequently. This means an ETF can actually have significant fluctuations in its price on a daily basis. There are actually multiple types of ETFs that you can invest in, so it's extremely important that you know and understand what your ETF is tracking and how it is made up. One of the most common ETFs on the market is called SPY, and this tracks the performance of the S&P 500. So how do ETFs work? An ETF is structured around the sole purpose of tracking the performance of its underlying index. It is not designed to outperform the market and therefore is a very passive investment option. The price of the ETF is determined by the value of the index it is tracking and therefore the underlying value of those assets that are being tracked. ETFs actually have very low minimum investment requirements. With the implementation now of fractional investing, you can get started by investing in an ETF for as little as $5. This really smashes down the barrier to entry and makes them extremely appealing for retail investors. Given that these are a passive investment option, yet they're extremely similar to index funds, there are still some fees involved for management fees. However, they are extremely low. So this makes them a very good option versus a mutual fund, for example. ETFs provide you with a range of opportunities to invest in. Maybe you want to invest in only the technology sector or a renewable energy sector, or maybe even some kind of ethical investment. There's ETFs for all of these, and that enables you to narrow down in a specific niche or provides you the option to diversify your investments, in example, the S&P 500. So you have a lot of choice and variety when investing via ETFs. So what are some pros and cons of investing using an ETF? A pro includes the fact that they are easy to trade. Another pro includes they have a low barrier to entry. You can get started investing in an ETF with as little as $5. Another pro is that ETFs have low fees. The lower the fees you pay, the more money you have to invest and compound for you over time. Some cons can include less diversification. If you narrow in on a technology ETF and only invest in that, there's a much higher risk that your funds could deteriorate if something were to happen to technology, like the dot-com bubble, for example. Another con is potential human error. By investing in ETFs, you're bringing yourself back into the equation, so be careful you don't let emotions get involved in your investing decisions when investing via ETF option. So which type of fund should you use to invest with? Now the answer to this will always come down to your own personal situation and what your investing goals are. One thing to consider for Australians is that your superannuation is already a mutual fund. So you're already paying fees on this investment vehicle. So if you're considering using a mutual fund to build your wealth, then you should potentially consider utilising your superannuation fund because of all the amazing tax benefits that it brings about. Generally speaking though, index funds and ETFs have much lower fees than mutual funds. So from a pure fee-based decision, they would be a better option as it would leave you more money invested and therefore compounding for you over time. Index funds and ETFs are both great low-fee investing options. Some questions you should ask yourself are whether you have the minimum investment amount to invest in an index fund or not. You should also consider whether you want to have control over the investments or if you're happy for somebody else to manage them. If you want to have control over them, or if you don't have the minimum investment amount, you should probably look at using an ETF. If you do have the minimum investment amount, or you aren't too keen on managing your own investments, then you should potentially look at using index funds to help build up your investment portfolio. Thanks for watching this video, guys. I hope you enjoyed the explanation there between mutual funds, index funds and ETFs, and now have a better understanding of which one you should use on your investing journey. Thanks again, and I'll see you next time.